Hello, hello. I'm Andrew from Beely Capital. Today I wanted to go through the Adyen reverse discounted cash flow analysis. So, to remind you where we left off last time, we had done a fully diluted shares outstanding, so we found the enterprise value for the company of 41.5 billion euros, and then we calculated the free cash flow and got 802 million euros of free cash flow, excluding the interest they earned on their excess cash. And so now we want to know, what is the company worth, and especially with the reverse DCF, rather than asking what is the company worth, we're instead asking what assumptions do you have to make to back into the current valuation, and do we think those are reasonable or not. So let's get started. So this is the main tab. I'm going to upload this entire spreadsheet. This is just a variable period, normal discounted cash flow. And I like this because it lets you decide how many years you want to manually project free cash flows. So kind of the industry standard is like 5 years of manual projections, and then it linearly declines. So say you have things growing 10% every year, and then you want it to linearly decline to 2% or 1% or 0% over the next 5 years. So let's say you wanted it to go to 0%, then you'd just do, hey, we're starting at 10, we're going to end at 0, and it's going to take 5 years. So we're going to go down 2% a year. So 10, then it'll be 8, 6, 4, 2, 0. And that's how you kind of get to that terminal growth rate. So this is probably the most common, 5 and 2. But the reason I have it set up this way is you can vary not just the specific growth rates, but then when you want to be done projecting that kind of higher level of growth, have it decline to some sort of terminal growth rate. And here, this is just US GDP growth over the last, I don't know, like 63 years since 1961. And it just shows you that, hey, if you look at it, you get an average of about 3%, a geometric mean of about 3%, and basically that just supports why we have a 3% terminal growth rate, but that's a variable. You can always change that. So anyway, how do you use this tool? The basic idea is we're saying the enterprise value for Adyen is 41.5. Note that this says dollars for everything, and I'm just going to leave the spreadsheet in dollars. We're using euros in our analysis for both enterprise value and free cash flow, and so those units cancel out, so it doesn't really matter what units you use here, like what currency, as long as you're consistent. But we're saying, hey, the current enterprise value is $41.5 billion. We want to have a 3% terminal growth rate. We're just going to assume, I don't know, if the rest of the world grows like the US has. There's certainly some problems with that assumption. You got to pick a terminal growth rate. You can change it if you'd like. Discount rate. So basically, how much do you think people would demand to earn to hold Adyen stock, or how much do you need to earn to hold Adyen stock? So if I'm an Adyen shareholder, I want to make at least 10% a year. I think it's a high quality business with, all those great network effects, economies of scale, inflation protection, all that sort of thing that we've talked about. I think that they're just competitively advantaged and win against the kind of legacy payment processors. However, it is like a high growth company. It's certainly macroeconomically exposed, where if spending goes down a lot, then their business is going to be hit. And so I want to earn at least like 10% because I think that's a high quality business, but I want to get paid for investing in companies. So you can tweak that as you want. And then I've just changed some projection periods. So again, Adyen's a high growth business, so I think that they can grow at like a higher rate for the next 8 years. And then I think that they'll kind of slowly grow less and less over time, especially as they get bigger, increase, their revenue and penetration in the general e-commerce market and payment processing in general. And so by year 15, I kind of have their growth flatlining, like they've achieved mass adoption and are now not growing any faster than GDP. So you can see here that for this spreadsheet, I've made it so that this number has to be between 2 and 20 years. It's hard to know what the what it's going to look like in 5 years, much less 20 years. And so I just kind of made that as the current limit, but feel free to change that if you want. So in addition to specifying the current free cash flow, you can, if you want, specify the 1-year free cash flow. And I believe I just used Bloomberg. If we go to Adyen for a second, there's just some sort of analyst estimate. Maybe 925 is what they're currently making, 986. I don't remember exactly how I got it. That I think it turned out to be, yeah, it was just an 18.2% growth rate. Why 18.2 and why does it have all these numbers? Well, this is the key part of this. So let's say that we thought Adyen could grow for the next 10 years instead of 15. Well, you might notice this number increased slightly and this number changed. So what's going on here is we're just projecting all these future cash flows, and now for the next 10 years instead of 8, you can see it's growing for the next 10 years at 18.2%. So these years the free cash flow keeps growing at this rate. Then the free cash flow declines and hits 3% in year 15 and so on. And so depending on how long you think this will grow, that affects the cash flows. We discount the cash flows back to the present, which is a pretty basic concept you'd learn in, like an introductory college finance course. There are tons of resources on that, but if you have questions, happy to explain it. So we're just getting the present value of the free cash flow. Here's the cumulative present value, which is just the sum of all these. And then we're doing the terminal value, which is kind of a well-known formula. It's like Gordon growth model, terminal value formula. And then we're just taking the present value of that terminal value. And then this is just the sum of the cumulative present value plus the present value of the terminal values. And so you'll notice that at a certain point, this number stops changing. And that point is basically when the company has been growing at 3% or when it's about to be growing at 3%. So really it's when the company is about to be growing at the terminal growth rate into the future. That's when this formula converges on a number, and then the value of the company will not change no matter how many more years you project out, because that's what the valuation is. It's saying that you can earn 10% a year, and here's the fair price to pay now for it. But what happened is us changing this period from 8 to 10 increased the amount of free cash flow, because now we have Adyen's free cash flow growing for another 2 years. And so now here we just have, this is the sum of the present value of all free cash flow plus the present value of the terminal value at the end of year 20. So this is just saying, hey, what's our overall company worth? And then this is the difference between what is the company currently trading for and what is the company currently worth. So the easiest way, since this is a reverse discounted cash flow analysis, is we can use goal seek here. So we're just going to do what if analysis, goal seek. We're going to set this cell, which is the difference between these two enterprise values, to 0 by changing cell, and we're just doing this one variable. So we're asking now, at what rate do Adyen's free cash flows need to grow in order for the next 10 years, and then linearly decline from years 10 to year 15 in order to give us a 10% rate of return for holding the stock. So if we think it's going to grow for 10 years, we get the answer of 17%. And I put in the piece some context around this. So I said that if you assume 8, which we'll go back to in a second, then you need that 18.2% growth rate. Here we only need 17. To put this in perspective, Adyen has grown revenue at a 32% CAGR in the last, this was since 2018, so the last 8 years. And EBIT, which is like a pretty good proxy for free cash flow here, at 28% since 2018. I think free cash flow might have been negative initially. I'm not sure why I used EBIT instead, maybe just a little easier for people to look at. So this has been a very high growth business, and it's still projected to grow very fast. In fact, we'll get to that in the quarterly update, but I think growth disappointed slightly, but was still in the mid 20% range or so in terms of revenue growth. And while their take rate has been decreasing, I'm generally expecting take rate to normalize and just kind of flatten out instead of continually decreasing. And then they should continue to have operating leverage on their expenses. And so free cash flow growth should over time approximate or even exceed revenue growth. So let me just change this back again to show you one more time, going back to the numbers I mentioned in my Substack. If you have them growing for 18 years, we want to set the difference of this to 0. And so we're going to do that again by changing the growth rate we need to have here. And so one weakness is, and we could move this over 1 and then everything just kind of follows this instead. So we could change this to, say, 3. Let's say we're really optimistic about Adyen. Now we could use our manual free cash flow here, and then we need to be changing this growth rate, which is going to control all the future growth rates. And now we've made this one blue. And this one's not really driving anything, because if this free cash flow is filled in, then it uses this. Otherwise, it's driven by the growth rate here. But we can see that we're now growing by more than this 18.2%. And so the valuation is higher than 41.5. And so to set it back to 0, if we are more optimistic about their free cash flows for 2025, we could change this and see that we only need 17.4% for the next years afterwards in order to get to the same enterprise value. So I hope this was an interesting and potentially helpful tool for you. There are a lot of different reverse discounted cash flows. I haven't found a great model of one, which is why I made my own and what I'm still working on. And so if anyone knows, I would love to get an answer on this. I want to make a data table where instead of the enterprise value changing, because that's sort of what this shows, depending on how long I think they grow at whatever rate I have, and this will tell you the different enterprise values, which is great and shows you, okay, hey, here's 100% of what it's currently valued at, but if it grows for just 10 years instead of 8 years, it's going to be worth 110%, or if it grows for 12 years or 14 years, and so on. So that's kind of nice and interesting, but what I'd really like is this to show me what growth rate. So if I think it's only going to grow for the next 4 years at a very high growth rate and then linearly decline to terminal growth rate in year 9, what growth rate do I have to have here? And so if I will just make this for a second. We'll probably delete this for now. These are all fine. And so I'm just going to, let's see, yeah, that's a table. These are all numbers. So we're just going to manually fill in 1 or 2 here. So right now we have 8 and 15, right? And so the growth rate we had to have was this number. There we go. But what if we did this for, we're going to do the 4 and 9. And so this is going to require quite a high growth rate. So we're setting this to 0 again by changing this cell. Okay, it has to grow at 31.6%. 30. So I should just copy this over. OSV, LTST. All right, so those are 2 numbers. Ideally, I would like this whole sheet to populate, and then I would like it to update automatically instead of me having to do this for what, 7 times, is that 7 times 6, so 48, I believe. That's always one of the hardest ones for me. But no, 42. See, that's why I got to double check myself. So 7 times 6. So rather than having to do this manually for 42 different cases, which would be a pain, I would like it to just be a table. But it's hard to do that because you generally can't make this an output of the model easily, because this is what's being solved for and driving everything. And I think it's algebraically hard to isolate this growth rate and make it dependent on everything else. So there's probably a way, but I've gotten kind of lazy and haven't worked on it lately. So if anyone knows, I'll leave this here blank. I'll include this in the Substack post, and people can get back to me on that. All right, that concludes the Adyen portion here. Let's see if I can pull up a quick update. So I'm just going to make a copy of this as well. And I forget why I particularly wanted to do this, maybe in case people are wondering about the quarter, kind of interested. I haven't built this out, and so I thought it might be interesting for people to see this together. And so I'm just going to use this same quarterly analysis I was using for oh yeah, does this have US equity and everything? Alright, we're going to try replacing US equity with equity. We still need the, this is fine actually. Okay, let's see if any of this works. Okay, the main problem is that Adyen just doesn't break quarterly stuff out so easily. So I cannot use this template so well, which reminds me of why I was going to do this. So the other thing I wanted to provide is something that I made and probably still need to pretty up slightly. I'll probably just publish like this, and then if anyone cares, make another version. I'll probably clean this up and publish late this evening. But this is the company's actual results since when I could get it easily, 2018. They restated some financials. It was the rare company restatement where their revenue and earnings actually increased. And there were some complicated kind of net versus gross accounting issues, and that led to this restatement. And so just as a public service to people, the company reports these with this green format, whatever. So I've mostly left it like that. I will have a version that's hopefully slightly prettied up. I'll mostly leave their green, maybe fix some of the formatting stuff that gets messed up when you stitch it together, and probably add in a couple things that I cared about, like net revenue margin, or I think I added this EBIT margin here, some other things like that. But I'll be providing this as well for people, just so you can see the historical company reported financials for a longer time period, because they only report it for a year or two at a time. And what I really wanted to do was update for Q1. So I will show you that process very quickly, and then we will talk about booking for like 1 or 2 minutes, because I was looking through them and had a couple ideas. All right. So I'm looking through here. Investor relations, latest quarterly update, business update, earnings call. Maybe they don't give you anything. Let's see. They've got a business update that I can listen to. Here's the same download. Oh, here we go. Download PDF. That's going to be a little bit helpful. All right, just so you can see what I'm looking at for a second. This is the business update that they provided. It's kind of light on numbers, but we're just going to update what we can. So here we go. We'll just call it Q1 2025. Net revenue was, let's see, this is digital volume. I don't think they disclosed digital net revenue before. So that is going to be a new interesting thing. I'm just going to break out for people here. And then, so we'll just give some subsets, digital, net revenue, maybe there's something else. There's their unified commerce segment. And there is, yeah, I should probably move this over. Okay. And then there is the platforms segment. And we're gonna this, and we're just gonna call it net revenue. I should have done this. And then we're just gonna bold these so we know here. And now we'll just copy and paste this for some formatting. So they said 320.4. So it's interesting that this is in euro thousands. So we're just going to make it euro thousands for now. And then unified commerce was 158,800. And since I'm manually typing in things, it bothers me to manually type them in without being blue, because I make mistakes on this all the time and then I have to check myself. And so I want to know that this is something I should be double checking because I did it. All right, so they said up 13% year over year. I don't think they've disclosed this before. Okay, they did. So quick check, we're gonna add up all these together. They said 534.7 million euros, which they claim. See, this is the other thing that I might fix over time, but they just make all these hard codes, which is bad practice in my opinion. All right, let's align it right. There we go. It's still a different size. Oh, that bothers me too. Let's make it. There we go. Now it's at least matching the same format. Their format looks weird, but at least it's consistent-ish. Although, I don't know if anyone, you might have investment banking eyes if you can see that this white border they put around the cell is here and not here. And that's bothering me too. So we fixed it. All right. This is probably easier for people if I'm zoomed in more anyway, especially if you're not watching on a big screen computer. All right, so they mentioned this. Growth was broad-based, led by Europe and North America. Unified commerce was up 31%. Digital was only up 13%. And so we might add like a growth rate. And I like this to be italicized. It's just kind of a convention. So we'll do that. And here we go. And so, unfortunately, I don't think they give us any past results. So we're going to have to back into those by saying it's this divided by 1.13. And then we're going to copy formatting over. Personally, I don't like no grid lines because then I don't know if I'm matching what I should be or not. This divided by 1.31 because it grew 31%, and this divided by 1.63 because they had very strong growth in their platforms, which is exciting, and platforms is a big growth opportunity theirs. All right. They hired 110 people net. So they're continuing to plan to grow net revenues annually between the low 20s and high 20s% up to and including 2026. And then EBITDA to above 50%, which it already is above 50%. Let's see, they had an EBITDA margin here. So for the year it wasn't, but for the second half of 2024 it was. I don't think they disclose any EBITDA or anything here. So overall, results were okay. I think a little weaker than analysts expected with only 22% revenue growth. And we saw a little bit how sensitive the valuation is to that near-term revenue number. And the more it grows now, the less it has to grow later on. The less it grows now, the longer you need it to grow in order for Adyen to be worth the current price. So I think this is not too concerning overall. Still very strong growth. And we will just do this -1, make it. I like 1 decimal on my percentages because sometimes people really care about 3 versus 3.4 or whatever else. And so it's just helpful to see that over time. So maybe I'll do that, but these are all just hard-coded, and I'm just matching their thing for now. So I'll leave you with this small update. Not a whole lot changed. I don't think they gave a constant currency basis. Oh, they did give one. Here we go. They called it 21% on a constant currency basis. So they benefited a little bit from currency, which is probably the weaker dollar, which is leading to some other effects for the quarter. And I will show that in a moment. And that's pretty much it. I have to catch up to the call because I haven't gotten a chance to listen to that yet. But I think that was released this morning. But that's the main update. I don't think they provide an update on processed volume or any of this. Oh, they did, and I missed it. So let's do that. 314, spot 8. This is Q1 2025. And there's, I think, eBay or someone else who was a big customer, and so excluding that customer, their processed volume increased 25% year over year, which is obviously much better because this only grew like 6% year over year, which we can calculate here. Match this formatting. Okay, I don't think they broke out anything more on their processed volume, did they? Oh. They did, kind of. They said it was this divided by 1.08. So, whoops. Need to select Q1, not Q2. And then we'll match that. So we're just kind of backing into these numbers, which I don't love. So and since we're manually typing them in, I'm going to just put them like this. Where else does it say? Process volume. Volume contributions. I believe processed volume. Yeah, processed volume must be all volume, and it's not the point of sale processed volume because they have it for digital, and obviously digital does not have a point of sale attached to it. All right, so this, now we get to do times 1.37 because they had significant growth here. We'll just do this again. And I'm just, in case you don't know, if you have a cell and you want to copy its formatting, you can Control-C to copy and then Alt-EST. So you just hit the Alt key and then in order EST, it'll bring up this Paste Special menu. You'll see the T is underlined here, so you can use that for the keyboard shortcut. So Alt-ESV is values, T is formats, and then you just hit OK, and it does the format. And then you can also, once you've done something once, you can just hit F4 to do the same operation in Excel again. So little things that save a decent amount of time. And then this is 1.63. Wait, nope, that was the revenue. So their volumes only went up. Oh, here their volumes only went up 23%, but excluding eBay, it was 61%. So what was the big digital customer if not eBay? I'm not all the way sure on that, and I would kind of like to know, but losing one big customer while meaningfully slowing their business here, I don't think that's very likely to recur going forward, so I'm willing to give them the benefit of the doubt on this. I don't think they give us point of sale volume for any of this here. Yep. And so those are basically the answers, and then this should really be a and this doesn't get us to exactly 314.8 because they're just giving us rounded percentages, which is part of why I don't love this. So they said it was up 23%, but really it was up 22.67% or whatever in order to get these numbers. So that's why I'm leaving these blue. They'll have to be updated slightly. They should be within 1% of the correct answer, but we'll update them in order to get these two things to tie properly. All right, that concludes the quarterly update here. I will include these financials as well. Probably make the Substack post this evening, hopefully. Last thing that I wanted to show briefly that I thought was interesting was Booking. I was looking at the recent quarter, and let me find the... it's here. So I had Adyen here as well. All right, we'll close out of the Adyen stuff for now. Actually, I'm going to open that again because I need to save that down. I like having a folder per company to just save down the latest information. And I accidentally closed away from the live stream, so I'll have to pull that up. Hopefully listen to that this evening. Hopefully it has an option to listen to it faster. Last thing is Booking's actual earnings were terrible, but you won't hear about that very much because their adjusted earnings were fine, and that's mostly what people cared about. So adjusted EPS grew 22%. Here's the adjusted net income. Looks pretty strong compared to to the year ago quarter. But if you look at just the net income, GAAP EPS, it was $10 versus $22 a year ago. So they were making half as much money as they were last year, maybe even less than that. What's going on? Well, they have this big adjustment primarily, which I will talk about briefly and maybe estimate. And then the other thing that's going on is they had this change in fair value. So I just want to explain quickly what's going on. Booking is excluding some expenses that they don't think are going to be ongoing expenses. They're claiming these expenses are just one time. And so they are saying, hey, investors, ignore these. Everything's fine in the core business, business as usual. So let's evaluate this to see if what they're saying is true. And spoiler, I think it's pretty reasonable. Like, I'm not a big fan of adjusted earnings. I want to know what the actual earnings are, but I agree that these are likely to be one time or not predictable. And so it's at least semi-reasonable to strip them out, but we'd kind of want to look for a pattern in this. And the part that it is a real expense is there is some underlying economic reality that changed, and that there was kind of a big expense incurred in the quarter. So first, there's a change in fair value of the conversion option of the convertible senior note. That may sound pretty complicated. Basically, if you read their filings, I'll show you where in the 10K, it says, hey, we have a senior note due May 2025. And it's right here. And outstanding principal amount is $784 million. If we scroll down to this, it just says that it's included in short-term debt. Doesn't matter too much. But there is somewhere, and I'm not sure if I have it here. Yes. So here we go. So that was the annual report. This is the 10Q quarterly report, where they point out that the May 2025 notes are convertible at a current conversion price of 1866.02 per share. I didn't go back and read like the actual bond prospectus, so I don't know if this is a euro-denominated number, because most of their debt, as you can see, is denominated in euros, because Booking is still like 50%-ish Europe. And then they're just converting to a dollar share price. That's my most likely outcome, but I don't know for sure. But I'm just going to walk you through some quick math on this. So here's the principal amount, 784. We're just going to leave it in US dollars. That was the units here. Outstanding principal amount, US dollars, 784. Then, what's this? This is the strike price. Here's the problem. Here's probably why my math's wrong, because I typed this in wrong. So let's make this strike price. And this is all about their, whatever they called these, 0.75% convertible notes. Let's delete the subscripts because we don't need them. All right, let me fix some formatting. Strike price, we'll say actuals. Make these blue. All right, so this is the share conversion amount. And we'll just point out that it's in millions so people know that. Okay, we're going to format that up a little bit. Now, here, we'll just do all of this. All right, what is this stuff? So this is Booking share price 331/25. So I already pulled this. I'll just show you quickly. Here we go. So Bloomberg, if you do look at 331, it was 4606.91. I could have, whoops. I could have looked this up somewhere else. And in fact, maybe I should, because I think that Bloomberg is super picky about using even basic pricing data. Like they don't like you typing it into Excel because they're worried you're going to replicate their system. So, okay, I looked somewhere else and I got Yahoo Finance, 4606.91. Great. Now I've done my duty to Bloomberg. Now we look at the end of December and we get 4968.42. What do you know? Bloomberg data was right. It's pretty good most of the time. Big fan of Bloomberg, in case you can't tell. That's why I use it. All right, so what's going on? Well, Bookings right now owes $784 million in debt, but the people who own this debt have the option to convert their debt into shares at $18.66 a share. So they could turn this debt into 420,000 shares. The shares are worth a lot more than that. This convertible senior note is very in the money. So here's how much the liability would have been, how much it would cost Booking if they converted all their shares at the end of December. The price was higher. It was going to go from 784 million to about 2.1 billion, which if we pull up the appropriate, let me find it. It's right down here. So they told us also in this note at March 31st and December 31st, the fair values were 1.9 and 2.1 billion respectively. If we look here, that's what we get. We can we might have to squint because I don't know that it'll round for you. But you can see this is 2.1 and this is 1.9, and that's what they tell us. The difference between those is 151.88. So we could probably label this a little bit, Booking share price, and then this is the of stock. I don't know. Value of converted shares. So if the debt was converted. And then this is the difference in value. So basically what happened is Booking shares went down, and so the liability, the amount that they're going to have to pay bondholders in equity, has been reduced by about $158 million. Now, I'm running long, as per usual here, so I was going to walk through this quickly, but the basic idea is that they also have some debt denominated in euros, and I was going to look at that quickly, and it's basically, let me just add it up super fast for my own sanity, because I wanted to double check this. 750, 1,000, 750, 500, 500, 750, 1,000, 650, 600, 1,250, 1,000, 850, 500, 750, and 700. All right, so we just added up all these. These are gone now. So we get about 11.5 billion euros. Last thing I want to do is USD euro. We're just going to look at how much has this price changed from 331 to 1231, 0.96. So basically, it used to be the dollar has depreciated. So it used to be that in order to get a dollar, you'd have to pay 9.6 euros. So you had to pay like 96.97 cents. Now you only have to pay 92 cents. So the euro is stronger, and basically, so the euro has basically appreciated by like 4.5% or something, if I'm doing the math properly. And so if you take all the debt that they have times that percentage, you get an extra cost to their debt of about 500 million euros. And so what Bookings is saying here is actually it's a little more complicated. They may have some hedges. There are a lot of other potential things. They may be using an average price rather than the spot price on the last days. But they lost about $400 million in the quarter because their debt is denominated in euros, but most of their business is denominated in dollars. And so the euros that they're going to owe back are going to cost more dollars, and they're going to cost about 400 million more. So this is an example of how currency movements can impact the P&L of a business, although they just adjust it out and everyone ignores it and most people don't bother looking or care. But I just wanted to double check that Booking Holdings is still indeed making money and that I'm happy as a shareholder owning this company. Thank you. That concludes this. Until next time, have a good one.